The Chinese stock market is one of the largest and most dynamic in the world. It operates differently from many Western markets due to China's unique economic and regulatory environment. Here's an overview of how it works. Key features of the Chinese stock market: two major exchanges, Shanghai Stock Exchange, SSE, located in Shanghai. This is the larger of the two and primarily lists large-cap companies, including many state-owned enterprises. It has two types of shares: A shares, traded in Chinese yuan, CNY, and primarily for domestic investors. B shares, traded in foreign currencies like USD and accessible to foreign investors. Shenzhen Stock Exchange, SZSE, located in Shenzhen, it focuses more on smaller, innovative, and high-growth companies. It also lists A shares and B shares. Hong Kong Stock Exchange, HKX, acts as a gateway for international investors to access Chinese companies, particularly through H shares and red chips, companies with Chinese government backing but incorporated overseas. Stock Connect programs: the Shanghai Hong Kong and Shenzhen Hong Kong Stock Connects allow international investors to trade A shares on mainland exchanges and Chinese investors to trade in Hong Kong. Participants: retail investors, dominate the market, accounting for a significant proportion of trading volume, making it more volatile compared to markets dominated by institutional investors. Institutional investors, including mutual funds, pension funds, and qualified foreign institutional investors, FIIs, they are becoming increasingly influential. Key indexes: Shanghai Composite Index, tracks all stocks, A shares and B shares, on the SSE. Shenzhen Component Index, tracks 500 of the largest and most actively traded companies on the SZSE. CSI 300 Index, tracks the top 300 companies listed on SSE and SZSE and is often used as a benchmark. Investment restrictions: historically, China imposed strict controls on foreign investments. However, programs like FII, BFI, IMB Qualified Foreign Institutional Investor, and Stock Connects have eased these restrictions. Foreigners can primarily invest in Chinese companies through H shares or Stock Connects. Regulatory environment: China Securities Regulatory Commission, CSRC, the primary regulatory body overseeing the market. Strict government oversight: the Chinese government plays a significant role in influencing the market, including IPO approvals, trading halts, and policy interventions. Daily price limits: to reduce volatility, stock prices on the mainland exchanges have daily movement limits, usually ±10%. Market characteristics: high volatility, driven by retail investors, speculative behavior. Policy-driven movements: changes in government policy can have a significant impact on market sentiment and stock prices. Limited diversification: the market is heavily weighted towards sectors like banking, energy, and technology. How to invest in the Chinese stock market: domestic investors use brokerage accounts in China to trade A shares directly. Investment is subject to regulations like account opening and margin requirements. Foreign investors trade via Stock Connect programs or invest in exchange-traded funds, ETFs, focused on Chinese stocks. Use Hong Kong-listed H shares for broader access. The Chinese stock market represents a unique blend of government intervention, rapid growth potential, and emerging market challenges.